The anticipation for a Lucid Motors merger with Churchill Capital's CCIV SPAC has been one of the hottest topics on the market. With plenty of rumors circulating and a deep desire to invest into the EV sector, CCIV has a lot riding on it, explaining the over 200% surge in the stock price in recent weeks. But what if the merger doesn't follow through? What would happen to CCIV stock in the worst case scenario in the upcoming months and weeks? In today's video, we'll be discussing what could possibly happen to CCIV stock, what we think would be the worst case scenario, and why it may not be as bad as you think. Let's get started. Hello everyone, this is Mark with MC Stocks. Remember to subscribe and hit the like button for more videos like this one. And as always, remember to do your own due diligence when investing and seek a financial advisor for professional advice. So you're probably already familiar with the rumors around the potential Lucid Motors and CCIV merger. The electric vehicle company, Lucid, may become a publicly traded company soon through a SPAC merger. With all of the evidence, theories, rumors, and leaks, the chances of the Lucid CCIV merger following through seems very probable. Day by day, we get more news added to our repository of information that continues to point towards a likely merger. For instance, take a look at this screenshot. Here we can see that Lucid has officially reserved the name Lucid Motors Corporation. This action typically happens shortly before a merger deal finalizes. Does this mean that they will merge? Not necessarily, and we do have to take all news and leaks with a grain of salt. But with everything that we've seen, read, and heard, the likelihood at least seems very plausible. So as diligent, careful investors, however, we do need to take a look at both sides of the coin. On the upside, we can clearly imagine the benefits of a merger following through for all parties. Lucid would be able to get into the public market quickly and likely in time for their first deliveries. Likewise, we could see CCIV stock skyrocket further as more EV investors pile in. But let's consider what if this is not the outcome. What could happen to your current investment into CCIV stock if we do not hear that Lucid will merge with CCIV? Are all hopes lost for the money you put in? Let's first look at what the SEC has to say about SPACs. This article goes into full detail on what you should know about SPACs and how they compare to IPOs. We will focus on the trust account section. They explain how you are entitled to your pro rata shares of the SPAC's trust account, and not the price at which you bought the SPAC shares on the market. This means that based upon the terms of the trust, a SPAC can return to you a certain amount of money agreed upon beforehand. And we can see that on CCIV's 10Q form submitted to the SEC, public shareholders are entitled to redeem their public shares for a pro rata portion of the amount then in the trust account, which is initially $10 per public share, plus any pro rata interest, and the net amounts withdrawn for working capital requirements. With these SPAC details in mind, let's speculate about the different scenarios that CCIV could fall victim to. The first scenario is that Lucid decides that they could not reach a deal with Churchill Capital and will therefore not merge with the SPAC. Whether this be due to monetary disagreements, leadership conflicts, or different company outlooks, the merger between Lucid Motors and CCIV is not guaranteed and cannot be fulfilled for any number of reasons. In this case, each company will continue on their own paths. Lucid has many alternatives to going public if they even choose to do so, and CCIV carries on, looking for another large company to take to the public market. This scenario is probably the least pessimistic outlook for CCIV stock. Surely the lack of a merger deal announcement will strike a blow to CCIV stock, but not closing on a deal is fairly common for SPACs, and is to be expected whenever invested in one. Nothing truly changed fundamentally about either company, and the reputations of each could remain untarnished in the eyes of most investors. So CCIV stock could probably hover above the typical $10 SPAC price point, since it can still merge with another large company without much doubt in investors' minds, and could see similar bull runs on the news that they are in talks with another company. Now let's move on to the next, more pessimistic scenario. In this scenario, we will consider the case that Lucid decides to not follow through with the merger and announces that they have an IPO. An IPO announcement like this, with all of the existing speculation and rumors surrounding a potential Lucid CCIV merger, would be a pretty big blow to CCIV stock. If Lucid were to choose to IPO after they were in talks with CCIV, Churchill Capital's reputation would be tarnished in the sense that they could not convince Lucid that a SPAC merger was the better route to go public, and so much so that Lucid chose to go public on their own. Now clearly there are pros and cons to going with a SPAC merger and doing an IPO, but from CCIV's perspective, closing on a deal is their top priority. For a fan-favorite company like Lucid to end up on the market separate from CCIV could cast doubts on Churchill Capital and may leave investors worried. In this scenario, we can once again expect the price to plunge back down to $10 at the worst. But news about CCIV being in talks with another company may not yield the same surge in the stock price due to the new doubts. Finally, for our last scenario, let's consider the worst news for CCIV, that Lucid Motors has decided to merge with another SPAC. Like the previous case, such a contradiction to all the existing theories, rumors, and evidence would be devastating to the stock. However, this case has the additional shock effect of it being completely unexpected by most investors who have been following. Up to this point, CCIV has been the sole SPAC candidate that has been presented to Lucid Motors according to most articles online. But for Lucid to end up merging with a different SPAC would be a real plot twist in the entire story. Lucid will still get the benefit of going public quickly with a SPAC, but the spoils of the deal will go to a surprise contender. In this case, not only could CCIV not convince Lucid with a deal, but they got outdone by another company. This would further tarnish the trust in the stock, sending it into a deep dive. It may be possible that the stock could dip below the $10 mark before recovering due to the shock of such an unexpected twist. But despite all three of these scenarios, however unlikely, we should notice a key point. The stock could always recover back to the $10 mark. We believe this is the limited downside benefit to SPACs that investors have been taking advantage of. So even in the worst case scenario, even if you couldn't cash out before the bottom is not at the bottom of the barrel. There are always risks in investing in SPACs, just like any other stock, but for a company like CCIV, and with their plans to go public with a fairly large company, the prospects for the stock, even in the worst case, are not too gloomy. If you're looking to buy shares of CCIV and need a brokerage, be sure to use our referral links in the description below. M1 Finance is doing a great offer currently where you could get a free $30 using our referral link. So use the link below, earn an easy $30, and don't miss out. Good luck everyone with your holdings, and stay tuned on our channel for any news regarding this Lucid CCIV merger. Thank you for watching today's video. Don't forget to subscribe and hit the notification bell to get notified when we release our next video. Please like and share for more videos similar to this one, and comment below with any questions that you may have so that we can address them in future videos. Thanks.